And so you have less to worry about in that respect. But at the same time, the counterparty system that's in the exchange-traded currencies are really, rest your mind, put you at peace. They're very easy to put you at peace. So I like that side of the advantages of the exchange trading. We look at accurate volume and open interest figures. This is very important. If you want to trade anything, you'd like to know the number of people who are entering in and out of the market, and this is clearly seen in the exchange-traded markets. Fourth, there is no bid-ask spread. As I mentioned before, while there are no overt commissions in over-the-counter currency trading, we have a problem where the bid and the ask spread may have 5 or 7 point difference, which creates a commission. Well, you have no such problem in exchange trading. What you see on the screen is the price that you may get in or get out at. So there's no bid-ask spread. And then the last great advantage of the exchange traded is the ability to hold on to a position. OTC markets only allow you 2 days, but you may have 3, 4, 5, maybe even a year, depending on what contract you buy on the exchanges, to hold on to a position and see a position come to fruition. You don't have to worry about interest rates or worry about rollovers or maybe even doing a forex swap where you're swapping the spot position you have for a forward position. So you have a lot more leeway in your time frame that you're able to trade. Now, the disadvantages of the exchange traded markets: they're only active during the Central and East Coast times. No matter how hard that the Chicago Mercantile Exchange tries to push their Globex trading, and no matter how hard the New York Board of Trade has their Dublin division working, or the Philadelphia Stock Exchange trying to operate, all of these are really fixated during U.S. time frames. So if you have a hard time trading during the day, it's going to be difficult for you to really catch a lot of the movement and momentum that the exchange-traded currencies can offer you. We've spoken about it numerous times. The second disadvantage is the significantly less liquidity that the cash forex market has. One of the problems is the new E-mini contracts that the Chicago Mercantile Exchange is promoting. They have the Japanese yen and the European currency available, and one of the things they're fighting with these new contracts is liquidity. There just is not enough volume happening day to day to allow people to get in and out of the marketplace, and so it discourages them to trade. So you have a chicken and egg scenario. So be careful when you're deciding to trade exchange-traded currencies to avoid more of the lesser-known currencies. I'll give you a prime example. I remember one time, the Mexican peso was moving very aggressively on an upswing, and we started to buy into the Mexican peso to profit. But part of the problem was that the Mexican peso didn't have the necessary liquidity. So while the OTC market was driving the real price up in the futures market, there's really no way to dump our positions. And so when we bought our positions and attempted to sell out, we ended up giving back 30% of the potential profits that we could have made had the market been more liquid. And this is an issue with a lot of exchange-traded foreign currencies that are lesser well-known. As you push up to the euro-dollar that we talked about earlier, where you trade Australian dollar, Canadian dollar, Japanese yen, any of these more popular exchange-traded currencies, you don't have that problem. But definitely make sure you pay attention to the volume issue. Another disadvantage is the margins are typically 2% of the contract value, as opposed to 1% of 1%. The other day we were looking at OTC market, and I wanted to find out how much the holding one European Union position was in the OTC market versus holding the same position in the exchange traded market. And there was about a $2,000 or $3,000 difference. I also looked at the Mexican peso, and in order to hold the Mexican peso, you may only have to put up $1,000 deposit to trade on the OTC market, but that same contract which equaled out on the exchanges to about 500,000 Mexican pesos, was about $6,200. So in that respect, there's about a $6,000 difference to trade the exchange traded. Part of the reason is there's less, part of the reason why this is the case is because the thought is if you have less put up as margin, less risk and less market fluctuation. And then we talked about this before. The level of volatility also changes the price of the margin that you have to put up. Well, OTC market, that's not the case. If they say you put up $1,000 to control 100,000 US dollars worth of anything, that's pretty fixed. So this is definitely a drawback for those people who want to use smaller amounts or want to hold a large number of contracts. The fourth problem is commission. Commission is an issue for anyone who wants to trade. The amount of commission you pay, I believe, is secondary to how well you enter in extra markets, but they do add to bottom line losses and take away from bottom line profits. So commissions are an issue when it comes to trading exchange traded markets. You have the NFA, which takes a commission, you have the exchange taking a commission, and whoever you transact business to trade with is taking a percentage of the commission. So that it can be a drawback when trading exchange markets. And then the final one is that the exchange does not reflect all the various forms of foreign exchange trading. As we spoke earlier, there's forward contracts, there's pre-spot, there's currency swaps, and then there's even more sophisticated derivatives that are over the counter, some that the LTCM used in the past. So you don't see a larger picture of everything that's happening in the foreign exchange market the way you could in the OTC market. But there are ways to work these two together to get clearer pictures. And as I said before, we'll talk about that in the tips section. Now we're at an important point in the discussion about foreign exchange. We covered the history of it. We talked about some historical anecdotes. We've broken down the differences between the cash market as well as the exchange market, talked about some of the advantages and disadvantages. Now we'll talk about some of the items that influence these markets and some of the tips and ideas to trade these markets together. First, let's look at the US dollar. The US dollar has several influences, but the primary influences on what affects the dollar are what happens with the U.S. Federal Reserve Bank. As I said before, central banks play a key role in what happens with the foreign exchange market. So the Federal Reserve Bank, being the central bank of the United States, has a lot of free information, a lot of forecasting data that you can use in order to decide how you want to trade for or against the U.S. dollar. And as I put here, their website address at federalreserve.gov. Then we look at the Federal Open Market Committee. They are part of the Federal Reserve. But what they do is they create the interest rate announcements that can move the currency market either up or down. And as I spoke to you earlier, it's a 24-hour market to trade. So it's good to have benchmarks on where and when you should trade. And one of these days that the Federal Reserve issues interest rate information is a good benchmark. Sometimes you may want to trade prior to the announcement, on the day of the announcement, and after the announcement, because you know for a fact there will be a lot of activity either based on speculation or fact during those time periods. Then we look at the Fed funds rate. It's the rate that banks charge each other for overnight loans. This is a very important number to know because it determines what is happening in the OTC market and how the interbank, interdealer market is operating. So it's a good number to know, and it can affect how you trade in what markets you decide to trade, depending on how aggressive or unaggressive the Fed fund rate is. And then lastly is the discount rate. It's the interest rate charges for emergency liquidity. As we saw with the LTCM example, the Federal Reserve Bank of New York stepped in and brokered a deal for them and helped them obtain emergency funding. Well, they do this all the time, and this is what the discount rate is. It allows commercial banks to have the capital necessary to continue operations overnight or for a particular extended period of time. It's a good rate to know, and it just kind of gives you an idea of what's happening in the marketplace in the OTC market as well as the futures exchange market.